Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Dialing down, China is said to be considering suspending its 125% tariff on some US imports. Global stocks gain for a fourth day as trade tensions cool and Fed officials suggest they're open to cutting rates. The US set to demand that Russia accepts Ukraine's right to have its own army as part of a peace agreement. Bloomberg understands US envoy Steve Witkoff will raise the issue with President Putin in Moscow. Plus, a tale of two tech giants. Alphabet shares jump on strong numbers from its Google search business, but Intel's woes continue as it warns a tariff-fueled recession could torpedo chip demand. Happy Friday. Global stocks then set for their longest winning streak in 2 months. 4 straight days of gains. Futures pointing to further upside after 3 days of gains for European and US stocks. If the picture continues to evolve in this positive direction, then you will be set then for 4 straight days of gains for both US and European stocks. Futures then pointing higher by about 0.5% in Europe after gains of around 2% by the end of the close yesterday. FTSE 100 futures here in the UK as you look at a bit of a lift to the commodities markets. Oil prices are higher in the session. FTSE 100 looking to add 0.2% despite the consumer sentiment survey here in the UK looking lackluster. S&P futures stateside looking to build on the gains of yesterday, up 0.4%. Nasdaq 100 futures tie into this, the Alphabet earnings, the optimism there, and you're looking at gains of 0.4%. Let's flip the board and have a look cross-asset then, because it's not just the earnings story, of course. It's some moderation around the trade and tariff story coming through from both China and the US, and we'll break those stories down for you in the next couple of minutes. But also Fed officials suggesting that possibly June could be in play for the next cut from this Federal Reserve. At least that's the view from one Fed official. The US 10-year currently yielding 4.29. You see some big moves yesterday in terms of Treasuries bids and yields down, and we'll see if that story continues to evolve. 4.30 right now on the benchmark US 10-year yields down 1 basis point. 1.32 right now on the pound. The pound is weaker versus the dollar by 0.4%. That's partly and largely down to dollar strength that's coming through in the session. But you can also expect that there's a build-up to the retail sales data out of the UK and also that concern about the health of the UK consumer. Brent at $67 a barrel, a bit of a lift actually for oil prices, as I mentioned, so the oil majors could gain in the session. Look to that at 8 a.m. UK time, gaining 7 to 0.8% on oil so far in the session, and gold going off by 7 cents. The safe haven getting a bit of a look past, at least in this risk-on sentiment for now. 3,325 right now on the yellow metal. Let's briefly check in on the Asian markets because you've seen some upside there as well. China suggesting that it's going to be easing some of the tariffs, at least considering easing some of the tariffs that it's posed on US goods into that country. Across the benchmark then, the MSCI Asia Pacific up 0.7%. The CSI over on mainland China currently gaining 0.3%. The Nikkei in Japan benefiting from weaker yen, currently up 1.8%. Talking of the yen, down 0.7% versus the US dollar at 143. Let's get to that China story then, because Bloomberg understands China is considering then suspending its 125% tariff on some US imports as the economic costs of the trade war weigh heavily on certain industries. Goods being weighed for potential exemption include medical equipment and some industrial chemicals. For more, let's bring in Jenny Marsh, who leads our Greater China Economy and Government team. Jenny, good morning. Thanks for joining us. What do we know?
So, as you said, people familiar with the situation and the planning in China are saying now that China is sort of mirroring what the US did earlier this month, which is removing certain items from these huge tariffs that have ramped up on both sides. This was sort of mirror what happened during the first trade war, when China also had exemptions for items sort of as soybeans. This time around, it's for medical equipment, chemicals that are important for plastics, and we're even hearing potentially for some chips. I think so far we've seen in this trade war, China has really gone toe-to-toe with the US and everything that they've done, but they haven't ever exceeded US action. So even though they're doing this quietly, it would make sense because it would bring China back in line with where Trump is at after he rolled out some exemptions for electronic products earlier this month.
Yeah, that's the context, isn't it? So you've had some exemptions, some adjustments from the US, now some adjustments from China. The mood music as well, certainly being pushed in Washington, is one of a slightly more constructive stance, even though China says, look, you need to drop all tariffs before we properly engage. Talk us through the market reaction, Jenny, to this news.
Markets reacted very, very positively to it. I think, people are just clinging for any sign that we're going to be inching towards a deal. Other countries around the world are sort of rushing towards trying to strike the first deal with Trump, whereas, the Chinese and the US at the moment can't even seem to agree whether they're even having talks. Trump keeps saying that talks are happening. The Chinese said categorically yesterday that no, they're not. So I think even something as small as sort of a few exemptions for a few products, I think to markets does show that perhaps there is some progress now towards sort of a de-escalation, even if it's just the beginning.
OK, Jenny Marsh, thank you for the context around this story as we continue to monitor, of course, the adjustments coming through from both China and the US. Are they actually engaging? As Jenny was saying, some confusion there as well. Leading our China economy and government coverage, of course, joining us out of Hong Kong. Markets getting a double dose then of good news, as we've discussed, because Fed Governor Chris Waller says he would support rate cuts if President Trump's tariffs lead to higher unemployment. Take a listen.
Wouldn't surprise me that you might start seeing more layoffs, tick up in the unemployment rate going forward if the big tariffs in particular come back on. If I see a significant drop in the labor market, then the employment side of the mandate I think is important and we step in. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Bloomberg's Hetal joins me now for the market reaction. So, Val, a couple of catalysts coming through, the conversations around trade tariffs, some exemptions maybe that the Chinese are looking at. Then what we've been hearing from Fed officials. We've got the earnings story from Alphabet as well. Of course, this is a good day for markets, at least for now.
Yeah, good day for markets, a good week for markets as well, Tom. They really got that Friday feeling, helped by that dovish Fed speak yesterday, which saw a decent Treasury rally across the curve, led by the front end. Those two-year yields headed 8 basis points lower in the last two sessions as we revive some hopes that the Fed could cut at its meeting in June. The equity market is already feeling some good feelings from this as well. Take a look at S&P futures on the week, Tom. We're headed for the second best week of the year. S&P futures in the last 5 sessions up over 4%. Second best week of the year for the U.S. equity market. We're now on a 4-day winning streak for the S&P 500. Lastly, got to talk about what's happening with the dollar, Tom. The dollar is also strengthening off the back of this good news around tariffs. Tariffs being lowered is now a good news for the dollar. We are seeing those safe havens that have acted as safe havens as late, be it the yen, be it the Swiss franc and the euro, all headed lower. Also seeing gold headed lower this morning as well. So it seems like markets are on a great start to this Friday.
Valerie Hetal, with the optimism there coming through for the markets, at least for now. We'll see how tenuous that is or how sustainable it is longer term. Val, thank you for the breakdown. To one of the other catalysts then, and we touched on this, Alphabet shares jumping in extended trading after the Google parent reported first quarter sales that exceeded analysts' expectations. You can see, of course, the after-hours gains there. The results were driven by strength in the company's search advertising business. And Bloomberg understands gains on an investment in Elon Musk's SpaceX. I'm joined now by Matt Bloxham, Senior Tech Analyst for Bloomberg Intelligence. Matt, talk us through what stood out to you then from these earnings. To some extent, the fact that the search business performed well is counterintuitive, given the competition that they're seeing from the likes of OpenAI. But it was a decent performance, at least on search. Top line, it was a beat.
Yeah, it was. Like I say, search is really important for them. It's, the vast bulk of how they generate their revenue and their profit. The other standout, I think, was the profitability in their cloud business. Now, their cloud business is lagging the big players like Amazon Web Services in that marketplace, but it's still growing at kind of 28% year on year. And the profitability, which historically has been an issue for that business, beat expectations. But yeah, I think really the focus on that advertising business, which, as you say, is under a structural threat from the AI-driven competitors like ChatGPT. Are we seeing a real shift in how people search the internet? And if they do shift to these other platforms, then what does that mean for how Google makes money? And surprised, I think, is how most analysts were feeling that it's being so resilient. But there's still a kind of lot of issues to come for that business, I think. OK, so we go from Alphabet then to Intel, a very different story, yes. A new CEO, and really outlining the challenges that this company is facing. Yeah, that's right. So a familiar theme we're seeing in these results is that Q1 results are being better than expected. And in Intel's case, that's because customers are pulling forward demand because they're fearing what things might cost them once the tariffs kick in, if they do kick in. And we've seen that with people like Nokia and Ericsson too. But a very bleak outlook for the second quarter revenues, about an 8% miss versus the consensus expectation. And it is because of that pull through and clients being fearful about future demand, and the new CEO being kind of quite pessimistic and downbeat about Intel's position, particularly in AI chips, where it's kind of really missed the opportunity, and how long it's going to take to turn that around, and the restructuring that needs to go on inside the business to kind of really right-size it. And it's very difficult as a big organisation to grow the top line while you're shrinking the business operationally, and so that's going to be a real big challenge for them.
A lot of the story around Intel is relatively idiosyncratic. Alphabet, though, I wonder to what extent that tells us a story about what could come through, particularly with Amazon on the cloud part of the business. We have Apple next week as well. What are you gearing up for when it comes to the tech earnings next week?
Yeah, I think a similar story. I think in the short term, the trends are going to be pretty robust. I think most of Q1 happened before the kind of real fear around the impacts of tariffs kicked in. I think there's still going to be some caution about Q2 and beyond. Nobody really knows what's going to happen as a result of these trade talks, if they're happening between China and the US. So the economy could still hit a brick wall quite abruptly in the second half of the year. And if that does happen, then ad spending is going to go down. Online shopping is probably going to go down. Demand for AI and cloud computing is probably going to go down. So there could be a big slowdown still. So I don't think people are going to run away with themselves with excitement. I think they're just going to be happy that things are holding up better than expected in the near term.
Yeah, for now, as you say, and then it comes back to the gravitational pull of the tariff policy. Matt Bloxham, thank you very much indeed, breaking down the earnings and giving us a preview of what to watch for when it comes to Apple and Amazon next week as well. Those earnings on Thursday. Matt Bloxham, our senior analyst for Bloomberg Intelligence. Here's what else to be thinking about for the day ahead then. 7 a.m. UK time, we had that consumer sentiment survey really in the doldrums for the UK. We get retail sales out at 7 a.m. UK, and the forecast is that they're going to contract for the month of March by 0.5% versus the increase of the previous month of 1%. So to what extent is the retail sector and the UK consumer starting to fold as higher prices kicking in from April start to take their toll? Later, we're going to get BYD earnings, of course. This company, in terms of sales, outstripping Tesla, that Chinese giant that is selling more and more vehicles into the European market, coming through with their earnings. That will be one to watch, and we'll break those for you. And the Fed blackout period is due to begin. We've been hearing some Fed voices and some adjustments in terms of the view as to when the Fed could go on rate cuts, signalling that maybe they could bring those cuts forward, particularly if the labour market starts to weaken. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. The top story, as you can see, the dialing down of some of the rhetoric and some of the changes, in fact, around the tariff agenda from both the US and China, a story we continue to monitor for you. Coming up, the Trade Administration pushes for a peace deal in Ukraine. To geopolitics then, with envoy Steve Witkoff set to meet Russian President Vladimir Putin in Moscow. We have the details, the latest US proposal to end the war. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, to the geopolitical story of the moment, at least when it comes to Ukraine and Russia. Bloomberg understanding that the US is set to demand that Russia accept Ukraine's right to develop its own army and defence industry as part of any peace agreement. The move would push back on Moscow's insistence that Ukraine's largely demilitarise as a condition to end the war. President Trump is optimistic a ceasefire can be achieved despite Russia's continued strikes on Kyiv. And those strikes this week have been devastating as well in terms of lives lost. For more, let's bring in Bloomberg's Russia editor, Greg Sullivan. So, Greg, the Trump administration now pushing for concessions from Moscow. Critics would say it's been a long time coming. It's been a bit one-sided. That would be the view from some critics in terms of how they've approached this deal. Is Moscow likely to concede around the need for Ukraine to have its own defence capacity?
Right. As you said, up until now, critics have largely criticized U.S. proposals for being one-sided and favorable to Moscow. On the one hand, Kyiv and its European allies are likely to welcome this development. because they've been focused on Ukraine's security after the war, whether that's security guarantees from other countries or Ukraine having the ability to defend itself. However, from the Russian side, this has been a key demand of Vladimir Putin. It's one that he's actually used to justify his invasion, saying that he needed to demilitarize Ukraine. Knowing that that has been a key concession makes it unclear whether Russia will be willing to accept that going forward. It's also unclear how closely Trump will stick to that, given that this is really the first concession that we've seen them ask of Moscow. So those are some of the key questions moving forward on this demand.
We've been hearing as well, Greg, from Sergei Lavrov speaking to one of the US broadcasters and giving some kind of response in terms of how these negotiations are going. What have we learned from that interview, and what are the next steps that we're watching?
Well, you know, we've heard lately from President Trump that he's very optimistic on a deal, and that he said that he thinks he has a deal with Russia and just has to bring Zelensky on board. But Lavrov pushed back on that a little bit, saying that while things were moving in the right direction, they still saw issues that need to be negotiated. And now that we've learned of this new concession being demanded of Moscow, that's a big concession for the Kremlin, and it's unclear whether they'll be ready to accept that. In the early days of the invasion, when negotiations were ongoing in Istanbul, there were actually caps written into a draft agreement on Ukraine's military. Putin has sought to leave Ukraine with a military that would essentially be helpless to defend itself against future threats. So that'll be one of the that's one of the key questions here, is whether the Kremlin is willing to accept this moving forward.
OK, Greg Sullivan, Bloomberg's Russia editor. It's been a busy week. We continue, of course, to monitor that meeting between Witkoff and Putin that is expected in Moscow. Greg, with the latest. Thank you. Coming up, to the airline sector and an interview with the head of Qatar Airways. That company saying it can withstand the shocks from higher tariffs as the airline considers expanding its fleet. We're going to bring you our exclusive interview with the CEO. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Qatar Airways says it can withstand the shocks from higher tariffs thanks to a stock of aircraft spares that might otherwise be harder to source. Bloomberg's Giovanna Pesecci has been speaking exclusively to the airline's CEO about how the company is looking to navigate the impact of tariffs and delivery delays.
24-25 is a record-breaking profit for us. Nobody anticipated the geopolitical situation and the fuel price and all of these things. However, it was built into our budget, and this is why you see us again breaking our record this year.
Okay, looking forward to those earnings in a few weeks' time then. What about your freight business for the rest of this year, and again the impact that tariffs could have specifically on that part of your business?
You know, we will notice some impacts over there, but the good thing, trade will not disappear overnight. And the good thing about our business, our cargo business, we have long-term partnership with major companies worldwide, and we have agreed rates and prices with them. Today, are we able to meet demands? We're not. So if you tell me I'll give you 10 more freighters, I will put them into operation immediately. So even if demands go down, we're still covered because we are not able to meet the demand that we have today.
I see. Are you seeing any interest to develop new routes in freight on back of, again, the I guess, move towards a more multipolar world and different trading?
Absolutely not. You know, it's about working smartly with our partners. We don't have to do this ourselves. We signed multiple agreements to cover so many destinations and to expand our cargo network, whether it is in the Far East and South America and Europe. So this is basically, this should be an answer that yes, our cargo network keeps expanding. In a few days, we're going to sign a major deal with another major player in the market to expand our network, cargo network even further.
That was the CEO of Qatar Airways Group speaking to Jemana Besetchi exclusively in Doha. You're going to hear more from Qatar Airways CEO Badr Mohammed Al Amir at the 5th edition of the Qatar Economic Forum, taking place May the 20th to the 22nd in Doha. Learn more at QatarEconomicForum.com. Sticking on airlines, the CEO of Southwest Airlines says the US airline industry is already in recession. Bob Jordan says domestic leisure travel has dropped more than he's ever seen outside of the pandemic. Southwest is among a growing number of airlines pulling financial guidance for the full year as a lack of economic clarity weighs on consumers. And American is the latest US carrier to withdraw its full-year earnings outlook due to uncertainty surrounding the Trump administration's trade policy. The company says it will aim to reinstate its outlook if and when business conditions stabilise. It follows similar moves by Delta and the parent of Frontier Airlines. To the broader picture on trade now, because South Korea says it has reached an understanding with the US to prepare what it calls a July package on trade. The industry ministry says it expects a meeting with the US trade representative soon. Earlier, Treasury Secretary Scott Bessent said he expected a trade-focused agreement of understanding with South Korea as soon as next week.
We had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week as we reach an agreement on understanding as soon as next week. So South Koreans came early, they came with their A game, and we will see if they follow through on that.
US Treasury Secretary Scott Bessent, of course, speaking in the White House alongside the US President Donald Trump and, of course, the Secretary of State Marco Rubio as well, commenting there, the Treasury Secretary, on the progress being made between the US and South Korea on what they're describing as something at least of a potential deal. And more details could come through next week. The trade story is part of the mix when it comes to the markets. Let's check in on Asian markets then as well, because the headline that crossed about an hour ago was from China looking to reduce potentially some of its 125% tariffs on imports of US goods into that market. That's according to Bloomberg reporting, the team on the ground getting that detail for us. The MSCI Asia Pacific is gaining on the back of that something of adjusted views in terms of the trade conversations then between the US and China, and some progress, it seems, with other trading partners of the US like South Korea. So broadly across the benchmark, you're seeing gains today of 0.6%. Global markets again set for 4 straight days of gains as things stand. CSI 300 on the mainland in China adding 0.2%. The Nikkei over in Japan gaining 1.8%. So a strong session for Japanese equities, helped by weaker yen. The yen down 0.6% in the session versus the US dollar at 143. Let's do a deeper dive on the FX moves then, because you do have strength coming through for the US dollar today. You have the havens, though, unwinding some of the bid that we've seen on a more constructive view on these markets, at least in the session today. Euro dollar currently at 113. The euro has proven something of a haven in recent days. Currently down 0.4% versus the US dollar. Again, largely down to dollar strength. The Swissy as well, currently versus the US dollar, down 0.5%. And the Japanese, the yuan in China, the CNH, currently at 7.28, largely unmoved in terms of the Chinese currency. Bigger moves for the yen and the euro. Coming up, China weighing those tariff changes. We'll get the details next and the consequences. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Dialing down, China is said to be considering suspending its 125% tariff on some US imports. Global stocks gain for a 4th day as trade tensions cool and Fed officials suggest they are open to cutting rates. The US is set to demand that Russia accepts Ukraine's right to have its own army as part of a peace agreement. Bloomberg understands US envoy Steve Witkoff will raise the issue with President Putin in Moscow. Plus, a tale of 2 tech giants. Alphabet shares jump on strong numbers from its Google search business. But Intel's woes, they continue as it warns a tariff-fueled recession could torpedo chip demand. Happy Friday. Futures are in positive territory. Global equity markets set for the best winning streak in 2 months. 4 straight days of gains is what we're looking at if things hold as currently positioned across US and European markets. You had strength yesterday by the end of the close on the Wall Street, of course, and on European equities. European stocks ended up just over 2% by the end of the close on Thursday. European futures now pointing to build on that at 0.5%. FTSE 100 futures here in the UK looking to add 14 points, up 0.2%. S&P futures currently pointing above 5,500, looking to add 0.4%. And Nasdaq 100 futures, with the alphabet optimism tied into that story, pointing to gains of 0.4%. Let's check in. Cross asset, you had some decent moves into US Treasuries yesterday with yields down. That story continues, has not been derailed in the session today. We had the Cleveland Fed president suggesting that June could be open for the next cut from this Fed. 4.30 right now on the benchmark US 10-year. The pound at 132. We look ahead to retail data crossing at 7 a.m. UK time. Concerns about the consumer here on higher prices and sentiment surveys being crushed in the UK. Currently the pound down 0.4%. The data will drop at 7 a.m. UK time. And Brent up 0.5% on oil. Currently, that is the picture. And gold taking a bit of a knock, down 1% after the gains of yesterday at 3,314. The yellow metal, a bit of profit taking there, arguably, given the gains that we've seen year to date. Let's get a broader picture now in terms of the macroeconomic data, expectations around the Fed and other central banks, and how this ties into your thinking around investments. Hetal Mehta, Head of Economic Research at St James's Place, joins us now. Hetal, good morning. Thank you for your time. Let's start on the data out of the US. Yes, we've had some Fed officials suggesting that maybe they're more open to cuts depending on how the data comes through. We have the hard data, the soft data. Some of the data yesterday suggesting that the US economy remains in relatively solid footing. Of course, the tariff impact has yet to fully come through. Talk to us about what you're seeing on the data front in the US. How concerned are you? What are the recession risks right now?
So the hard data is obviously going to be stale. It comes out with a lag at the best of times. So what we're getting at the moment is data that's still kind of pre-Liberation Day in terms of the solid hard data. But what we're seeing in terms of soft data and sentiment is that is deteriorating. So investment intentions in particular have moved quite early, even ahead of Liberation Day. Saw investment intentions from a number of surveys starting to weaken. Consumer confidence, prospects for jobs, they're also looking a little bit fragile. And I think the key one that we want to keep an eye on now from here are employment intentions. So far, the labour market has been very good, but those kind of early warning signs that, are the cracks appearing faster than people expected, that's going to be the key thing for us at the moment.
OK, so watching the labour market, that resilience is there for now, but it suggests, at least you seem to be hitting or signalling that maybe a softer labour market is something that could be coming down the pike for the US. How is your thinking around the Federal Reserve's reaction function changed then? Some Fed officials suggesting that maybe they would be more reactive than the markets had thought. What are your assumptions right now about how the cuts come through from the Fed?
So my kind of general working assumption is that the tariff shock is going to be stagflationary. We will see inflation increase, growth slow. And our base case has been a soft landing, and our conviction in that is lower, but it's still our base case because we long thought there will be a slowdown. But if we see the kind of full increase in tariffs, and that really exaggerates the stagflationary impact, and that is the toughest policy dilemma for central banks. So we think that the Fed will have an easing bias, but it's going to be very cautious. And markets are pricing in quite a lot, I think, for the next for the rest of this year and for the next year in terms of cuts. They just think that if inflation stays high, those expectations risk being a bit disappointed, even if the growth weakness comes through, and that's why the labour market's key. The other thing for the Fed and their reaction function will be on credit conditions. So we know financial conditions tightened with all of the market volatility, but with credit conditions, and we'll get the senior loan officer survey next week or in 2 weeks' time, that will be one of the key things for the Fed to see. Are banks also starting to make credit less available because of that uncertainty?
OK, so watching credit conditions, Hetal, what is your take in terms of the fund flows out of US assets? Some of that is moderated in the last couple of days. Is that a theme that is going to be more sustained in terms of what some have described, at least, as capital flight from US assets?
So what we saw in the week after Liberation Day was not unusual in terms of the direction. So statistically, it's usually evenly split between dollars and the treasuries rallying and also selling off. You know, it's an even mix. But it was the extent of the sell-off of both of those, which I think was quite notable. We haven't seen anything like that in terms of the dual sell-off since about 2009. Now, capital flight is quite a strong term. You usually associate that with emerging market economies undergoing stress. But what it does highlight, particularly from a portfolio perspective, is that where usually you have these asset classes that provide a bit of an offset, that's actually not happening. And for us, the new regime that we're in, the policy uncertainty, we don't think that that's going to go away so easily. We have a new way of the US government engaging with markets and also other economic institutions, and that is probably going to be, the volatility at least is likely to continue.
Is the UK consumer starting to look weak to you, Hetal? We had the sentiment survey out overnight. We've got retail sales data later. What does that mean for the BOE? There's been some strength for the UK consumer. Is that story starting to unravel?
So I think for the UK consumer, we've still got inflation quite high, and that's still coming down the pipe. So there'll be some disinflationary effects, I think, from maybe the tariff shock, rerouting of trade, and goods that are no longer being able to. Say, for example, China can't sell to the US, they may work their way back into Europe. So there might be some disinflation impacts, but I think for the consumer, in the near term, inflation is still high. But the good news is that real incomes have been picking up in the last year or so. So actually, I'm not too worried about the UK consumer having some cushion, but certainly for businesses, we have higher national insurance taxes coming through. The uncertainty in the environment for making investment is still quite difficult. And I think what we had earlier in the year was temporary economic strength, which is probably not sustainable.
OK, Hetal Mehta, Head of Economic Research at St James's Place, on the Fed's next steps and the outlook for the UK economy. Hetal, thank you. Sticking with the UK, Chancellor Rachel Reeves says the US is right that global trade imbalances need to be addressed, but that President Trump is going about it the wrong way. Speaking in a debate at the IMF in Washington, Reeves said the US should be using multilateral institutions like the IMF rather than tariffs to reform the global trading system. She also warned that the UK government has no headroom to borrow more. And the ECB's chief economist, Philip Lane, says trade tensions with the US are unlikely to result in a recession for the Eurozone. The central bank currently forecasts GDP rising 0.9% in 2025, but will refresh its outlook for its next policy meeting in June.
It is a markdown. There is a markdown, but it's important to say it's a markdown from a growth rate around 0.9 to a little bit less.
The ECB's Philip Lane speaking there. And Europe's biggest companies are rounding out a busy week of earnings. They are far from finished, of course, with even more slated from Monday. Charlie Wells is here with a roundup of the numbers that have come through. Charlie, who beat, who missed? What are we drawing? What are we learning from the earnings so far?
Yeah, Tom, so we are in the thick of it. And so far, the numbers are coming in pretty strong, but we are not over yet. So far, we've seen 51% of firms in Europe that have reported showing beats. We're seeing 26% have shown misses, and 23% have hit it right on the mark. Now, if we want to talk about notable beats, we have to talk about SAP. They really were the talk of the town this week because they were able to show resilience in their revenue streams in a time of uncertainty. SAP BNP on Wednesday jumped the most in 6 years because they were able to bring in this solid earnings report and show that solid resiliency. Another notable beat was Nestle, the Swiss multinational. They were able to demonstrate to the market that they have the capacity to pass on higher costs on chocolate and on coffee, to the consumer. So we've got their CEO, Laurent Frex, talking about how they have that strength to pass on costs to the consumer. We need to talk about some of the notable misses, though. So Kering, the luxury company, was one that had a miss. And when you think about Kering, you have to think about Gucci, because 60% of Kering's profits come from Gucci. And so when you see pain at Gucci, that passes on to Kering. And, another notable miss here came from sorry, I'm kind of losing my train of thought here, from BNP, which is the French bank. The hope had been that their trading revenue would post a record, and it certainly did, but costs came in higher than expected.
Charlie, there's a lot to fit in. No worries at all. There's a lot to cover when it comes to the earnings story. There's going to be a lot more next week as well, Charlie. What are you going to be looking for? What are you most kind of hyped about when it comes to the earnings story out of Europe next week? Yeah, so huge theme here is going to be banking. We're just seeing some of the biggest names in banking reporting later. We've got HSBC, UBS, Barclays, Deutsche Bank as well. And, we've got to talk about, some of the negativity that's looming around the sector because of a lower rate environment, because of a lot of this uncertainty about tariffs. The other sector that we're really going to see a lot of reporting from is automotive. So you've got Mercedes, you've got VW reporting. And again, that tariff issue is going to be front and center. We've heard so much noise coming out of the United States. How are these firms handling some of that tariff difficulty? And I talked about tariffs. We've got to think about sectoral tariffs. We have pharma firms. We've got AstraZeneca. We've got Novartis reporting next week as well. And we need to end on this quote about sectoral tariffs from Donald Trump. The day that he said that he would be pausing country-level tariffs, we saw him bring in this idea about pharma-level tariffs, about trying to bring pharmaceutical tariff companies back to the United States. So that will be front and center as analysts parse through these earnings. Yeah, as investors jump on, modest good news when it comes to the tariff story today. The pharma story, of course, and those threats on that sector continue to loom. Charlie Wells with a breakdown, what to think about as well in terms of the earnings story next week with banks, pharma and autos firmly in focus. Charlie Wells, thank you. Coming up, we're going to discuss the European tech outlook with Tommy Stadlen, the co-founder and general partner of Giant Ventures, and to what extent Trump's actions and policies in the US might be benefiting Europe. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday. We have some lines crossing from China. The Politburo has been meeting in Beijing. Some key lines coming through in terms of the expected fiscal support then. The Politburo saying that China will cut the RRR rate and rates more broadly when needed. The economic recovery needs to be further reinforced, says the Politburo. Of course, China facing these 145% tariffs from the United States. China's fiscal policy to be more proactive. China's fiscal policy to be more proactive. The Politburo will be supporting enterprises affected by tariffs. So specific lines coming through from the Politburo on what they plan to do to try and reinforce this economy in light of those Trump tariffs, to support enterprises affected by tariffs, to increase the income of low-income groups. That is a theme that they've hit on before as well. They are looking to prevent and resolve risks in key areas. The key lines to me are that they are reactive and they're preparing to be reactive on those RRR cuts and the broader rates environment, and that they plan to be more proactive when it comes to fiscal policy. Also, this is an interesting line, they plan to establish new policy-based financial instruments and other measures when it comes to monetary policy. So new instruments around monetary policy and financial instruments. So we'll look for more details on that. They are preparing emergency plans amid external shocks. Politburo to prepare emergency plans amid external shocks. This is a reminder that this is a China that continues to build out what it hopes will be that resilience in the face of this trade war with the United States. And it could question some of those assumptions that China is going to fold anytime soon when it comes to this standoff. The Chinese markets right now, across the Asia-Pacific, you're seeing gains of 0.6%. The mainland markets are up 0.2, not moving a lot. The Nikkei over in Japan gaining around 2%. That's more on the story that China is potentially going to be adjusting some of the tariffs that it imposes on US imports into that market. Let's turn to the tech space now, because Alphabet's parent company Google and Intel have reported first quarter earnings, sending the stocks moving in opposite directions in extended trading, as you can see. My next guest says there's upside for European tech as investors seek to escape the trade uncertainty in Trump's America. Joining me now is Tommy Stadlen, co-founder and general partner of Giant Ventures. Tommy, thank you for joining us bright and early in the studio. One of the key themes for investors globally is whether or not US exceptionalism has ground to a halt. We've seen capital outflows. We've seen some questioning the risk premium that should be now attached and baked in to US assets. Link that story to what is happening in your world of private capital, of venture capital. Are you seeing any adjustments in terms of fund flows and talents as a result of that debate?
We are seeing both talent and capital reconsidering, which was almost unthinkable a few years ago, because the US has so long enjoyed an advantage in the tech ecosystem over Europe. What I would say, first of all, though, is both sides are suffering right now. The venture ecosystem and the tech ecosystem badly needed a year of liquidity. This pent-up demand of IPOs in the startup technology space has just been delayed and delayed and delayed. We're now facing another year without that. And we saw Klarna, for example, one of the European tech startup heroes, delay its IPO because of the tariff market chaos. So that's bad for both sides of the Atlantic. But within Europe, I think there is a major opportunity. And we're seeing some of our institutional investors rethink capital deployment away from the US into Europe. And we're also seeing talent flows change. And I think that's everything from, the young scientists who are seeing peers have their visas revoked and are rethinking should they be building their next company in the US or maybe they should be coming to Europe, all the way through to tech billionaire CEOs who maybe don't want to live in Trump's America.
On that redeployment of capital, is that a knee-jerk reaction, or is it your sense that this is a more sustainable, fundamental shift that we're seeing?
I think the answer is no one knows, and we could easily look back in a few years and say how ridiculous that people were questioning American exceptionalism, questioning the dollar. But I think the shocks to the market are so profound that we are seeing very large, smart institutional investors fundamentally question, is the year of American exceptionalism over? And I think there's also a lot of social political pressure in the Nordic pension funds, for example, with stakeholders saying, do we really want to be pumping more and more money into a US ally who is saying, let's take over Greenland? So I think that element shouldn't be overlooked as well.
On talent, Macron over in France has made a pretty clear call for this, saying scientists come to France, we are open. Some scientists, of course, being cold by the Doge cuts. Again, is that sustainable? Is that material? Are you seeing that in real numbers? Is this a trickle when it comes to headcount and talent moving from the US? What are you seeing on the ground, Tommy?
The interesting thing in my world of venture capital is that it only requires a trickle to be quite profound, because if we have one or two exceptional founders decide to build their next business in Europe rather than the US, that's pretty major. Macron and France have been at this for a while, stealing talent from both the US and London. But yeah, as a Giant, we decided to hold our global headquarters in London. 3 out of the top 10 universities in the world are within an hour's drive of London. And there is so much strong AI and biotech talent within the UK, lots of great talent. What we're saying to US founders is consider the UK for your next business. Market stability, rule of law, all things you would have thought the US offered, but that's now in question.
What about regulation, Tommy? We had the CEO of SAP on. They had gangbuster results. They're doing very well when it comes to AI. But he did say, the CEO, Christian Klein of SAP, that Europe really does need to focus on innovation before regulation. He's seeing some good mood music, but he wants to see changes. Cuts to red tape, it's still a challenge.
Well, so I think, the US has been marking Europe for a while. There's been that meme of the only thing Europe can innovate on is a bottle cap that's stuck to the bottle. I think that's unfair. I think a year ago I was concerned that the UK was more interested in being the best in the world at regulating AI rather than producing the next AI giants. I think that has changed. People have got the message that we cannot have this further for AI regulation, or we'll simply be left behind not only by the US, but also clearly by China, right, who are not trammeled by these regulatory concerns.
On the liquidity, and you flagged this, and Klarna is a clear example of that. It cannot IPO in the current capital markets, but we also need to see capital markets changing and adjusting here in the UK and Europe as well. How tight is that liquidity squeeze right now? What does it mean in terms? Are we going to see companies hitting the walls because they're not able to access the liquidity they need? Does it mean more secondaries? How is that story evolving?
You mentioned
how much pain is there right now?
You mentioned secondaries. That's the key evolution in the private market. So companies, they used to take 5 to 10 years to go public, having been started. That's fundamentally changed. change. The great technology startups now take 15, 20 years to go public. That's not sustainable for investors like me. And so the venture ecosystem has evolved to have a very well-functioning secondary market. That's going to grow and grow so that people can get access. The problem is that does not help retail investors who don't get access to the highest growth phases in startups' history. And so we have to have a more functioning public markets that can provide the capital that the private markets are currently providing to the likes of OpenAI and Stripe and others.
OK, and that clarion call has been there from your industry and more broadly, hasn't it, in terms of the need to reform those capital markets. And we'll see if further adjustments come here in the UK or in Europe. Tommy Stadlen, thank you very much indeed in terms of the capital flows, the talent flows, the adjustments in the VC world. Liquidity, a challenge, of course, as capital markets remain largely closed off in this environment. Tommy Stadlen, co-founder and general partner of Giant Ventures. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Friday. Some lines crossing from China's Politburo meeting in Beijing. Key lines. And this, for me, is a reminder that this is a China preparing and girding itself for a long, drawn-out trade war with the US. They are putting in place policy tools to try to support this economy. Some top lines coming through then. China set to set up new financing policy tools. China vowing to fully prepare emergency plans for external shocks. We await the details of those emergency plans. The Politburo also saying that it will cut the RRR rate in a timely manner. That is not a surprise, but it's the emergency policy tools that they are building out that, for me, is the key line. They will be more proactive on both monetary and fiscal policy as well. Those lines dropping just in the last few minutes. That story will be given more context and analysis through the next few hours as well. The gains coming through across Asia, up 0.4% so far in the session. Mainland China also up just 0.2%. When the S&P 500 is set for a fourth straight day of gains, partly down to some of the mood music around tariffs. China as well looking to adjust, possibly, according to Bloomberg reporting, some of the tariffs on US goods. The S&P 500, the level to watch is 5,500, according to some analysts. If they can break through that, maybe there's further upside. The opening trade is up next. This is Bloomberg.